As anticipated, our goal here is to briefly discuss how the participants in a blockchain network ensure the double entry accounting principle is taken care of. We'll also show you how this solution is different from the other existing solutions of the legacy financial system. In the Bitcoin blockchain, payments are settled through a so-called consensus mechanism, which works based on economic incentives rooted in game theory. I know this sounds a bit complicated, but we'll make it easy for you, I promise. The consensus process aligns the interests of all network participants, so their best course of action is to support truthful verification and record-keeping of all transactions. We'll cover the consensus mechanisms in more detail later on. For now, here's what Satoshi himself wanted to share about this issue. The problem, of course, is the payee can't verify that one of the owners did not double spend the coin. A common solution is to introduce a trusted central authority, or mint, that checks every transaction for double spending. After each transaction, the coin must be returned to the mint to issue a new coin, and only coins issued directly from the mint are trusted not to be double spent. The problem with this solution is that the fate of the entire money system depends on the company running the mint, with every transaction having to go through them, just like a bank. We need a way for the payee to know that the previous owners did not sign any earlier transactions. For our purposes, the earliest transaction is the one that counts, so we don't care about later attempts to double spend. The only way to confirm the absence of a transaction is to be aware of all transactions. In the mint-based model, the mint was aware of all transactions and decided which arrived first. To accomplish this without a trusted party, transactions must be publicly announced, and we need a system for participants to agree on a single history of the order in which they were received. The payee needs proof that at the time of each transaction the majority of nodes agreed it was the first received. So the root of the problem is to secure a consensus process through which all participants in the network are on the same page at any given time. This process must be so robust that all participants trust it with their money. The simple solution is to introduce a trusted central authority to run the ledger of transactions, just like a bank. As history has shown many times, such central parties or middlemen can present a risk of their own, and far too often have been compromised. Therefore, Satoshi goes for the more difficult solution, to secure and maintain decentralized consensus in a global payment system. In fact, this problem is so complex that nobody had ever solved it before. Let's run through a few examples of how different existing payment systems work. Banks have been the traditional payment intermediaries for centuries. They maintain accounts for their customers, process payments, and provide other financial services. They also maintain the relevant financial infrastructure. Currently, electronic bank transfers are done in the following way. An account holder orders a bank transfer from his or her bank account to another bank account. The sending bank uses IBAN and BIC codes to direct the payment to its destination. IBAN stands for International Bank Account Number. It is an international system for identifying bank accounts to facilitate cross-border transactions. BIC stands for Business Identifier Code, which is also used for payment identification. The sending bank transmits a message to the receiving bank via a secure communication network called SWIFT. This stands for Society for Worldwide Interbank Financial Telecommunication. The message contains instructions to the receiving bank to make the payment to the destination account. The banks involved must hold reciprocal accounts with each other, or the payment must be routed through a correspondent bank, which is another intermediary holding accounts with both banks on opposite sides of the transaction. The actual transfer is not instantaneous. Funds may take several hours or even days to move from the sender's account to the receiver's account. All banks participating in the transfer get fees for the services provided from the sender and the recipient. Credit and debit card transactions involve an even longer list of intermediaries. Besides the payers' and payees' banks, where they hold accounts, there are a bunch of other payment processors on both sides, and the Visa or MasterCard network in the middle. Visa and MasterCard hold huge market power in this value chain, and this is easy to see in their profit margins. Everyone can check that in their financial accounts as they are publicly listed companies. A basic credit or debit card transaction involves the following steps. A consumer initiates a payment at the point of sale, or POS for short, to a merchant or retailer. This is done via POS terminal if in-store, or via website if online. The merchant then transmits the sales data to a merchant acquirer. The merchant acquirer can be the bank, where the merchant holds an account, or another payment processor. Many banks participating in card schemes outsource this part, which is basically a back-office function, to external providers. The merchant acquirer routes the transaction request data through a card network such as Visa or MasterCard. The card network sends the transaction request data to the card issuing bank. The card issuing bank remits the funds back through the card payment network. The card payment network passes on the funds to the merchant acquirer. Finally, the merchant acquirer credits the merchant's deposit bank account. Needless to say, all intermediaries involved in the process get paid substantial fees for passing the money on through the system. This process can involve more steps if banks on both sides decide to outsource more of the back-office transaction processing to third-party intermediaries. The whole cycle, in theory, can be completed in 12 hours, but typically takes 3 to 4 days, depending on individual contractual agreements between the various intermediaries involved. PayPal functions as another electronic payment intermediary. It is an internet company with global presence. Its services are mainly targeted at e-commerce, connecting customers and merchants. All parties using PayPal and holding accounts with it can send payments to each other through the system. PayPal also integrates with the legacy banking and credit card payment infrastructure. PayPal is not regulated as a bank because it doesn't operate a fractional reserve system like banks do. This is related to the activity of taking deposits, making loans funded by these deposits, and keeping only a fraction of the deposits in reserve. This obviously creates credit risk for deposit holders. So as PayPal doesn't do that, it follows lighter regulation as a money transmitter. This model is quite centralized, similar to the banking model, and is subject to all the risks associated with that. To summarize, designing a centralized payment architecture is much easier than designing a decentralized one. However, the centralized model presents security threats from hacks because there is a clear and attractive target for such attacks. A centralized system also presents a more expensive and inefficient solution for customers because it tends to create monopolies or cartels. This would concentrate market power in the hands of a small group of intermediaries, which can extract disproportionately large value in the form of transaction fees. The customer outcome, resulting from the legacy financial infrastructure, is expensive and slow transactions. This sector has not seen any major innovation in a very long time and is ripe for disruption. In contrast, a decentralized payment network like Bitcoin implements the more difficult solution of decentralized consensus in transaction processing. This design enables it to deliver a much more efficient solution for all parties involved. Payments go directly from peer to peer, and security and processing are guaranteed by the entire network. Funds are sent and received in a matter of minutes. All network participants maintain consensus on the current state of the transaction ledger at all times. Doesn't this sound amazing? Direct peer-to-peer interaction is always a superior solution for all parties involved. There are no rent-seeking intermediaries stuck in the middle to extract value from the counterparties. And now we have the technology to do that in payments as well as in any other type of transactions involving value transfer or record keeping. If you like this solution, let's go ahead and develop deeper understanding of how Bitcoin works.